Good afternoon, everyone, and welcome to another one of Avant-Garde's free educational webinars. Thank you very much for reading through those disclosures. We are happy to have you with us this afternoon and thrilled to welcome back Keith Harwood. He is joining us to talk to us all about New Year's trading resolutions and a very timely presentation as we just jump our way into 2026. Keith, are you with us?
I believe I am. Thank you again, Natalie.
Oh, great. Thanks for being here and taking the time to present to our audience this afternoon. We really do appreciate it. I'll have you go ahead and take control of the screen and get your presentation up there. A reminder to everyone with us live in the Zoom room, if you have questions during Keith's presentation, please go ahead and put those questions in the chat box or the Q&A, and I'll get those over to Keith to address at the end. Keith, I can see your presentation looks good, so feel free to begin when you're ready.
Absolutely. Thanks again. And so today, as Natalie mentioned, we're going to be talking about some New Year's trading resolutions. So I think it's a timely topic, thinking about reviewing 2025 and what I want to change for 2026 to hopefully, ideally, end up with a better trading result for the year ahead. Before I get started, I always have my own disclosures as well, so I pulled those up here for you guys. General concept is that all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. I'll leave this up for a moment so everybody can read through, and then we'll get into the topic du jour. All right, hopefully that gave you guys enough time to read through those disclosures. And with that, why don't we jump into first introducing myself. For those that are new faces, haven't heard from me before, this is me. I'm Keith Harwood. I started my career in the option pits of the CBOE back in 2005. So about 20 years of trading experience now, a little more. After initially trading as a market maker on the CBOE floor, I transitioned to off-floor trading and constructing directional portfolios using options and futures as a market maker, proprietary trader, and a hedge fund trader. I also worked in risk management, options construction, et cetera, with the hedge fund. And I joined Option Hotline as our chief options strategist in 2018 to share this expertise in options, equities, fixed income, and commodity trading with the general public, recognizing that a lot of individual traders could really take advantage of this educational opportunity and ideally trade smarter. And part of that trading smarter is the topic, again, for today, of New Year's trading resolutions. Now, I know everybody's got a busy day, oftentimes, so if you do have to leave early, you can always email me directly. I'm keith@optionhotline.com. Or give me a call, 312-600-8004, and make sure you're keeping an eye out for an email from support@optionhotline.com where you'll get a free giveaway from me just for signing up today. And again, I appreciate everybody taking the time. So again, what are we going to talk about today? Well, as part of these New Year's resolutions, I have to think through big picture. What's driving the market today? What's driving the market in the near term? And how is that going to impact the changes that I may want to make for my approach to the markets, my approach to trading, and my goals for the year? And goals are the key here when setting my resolutions. I know the end point of what I'd like to achieve for the year, and how am I going to get there? Well, a number of great resolutions that I tend to think are particularly valuable for many is to look at new trading strategies, to reevaluate my profit targets, both on a portfolio level and an individual trade level, and journaling, keeping a record of what I'm doing so that I have an easier time next year when I'm going to go through and reevaluate for 2027, what worked, what didn't in 2026, what worked, what didn't in 2025. I can go back to 24, 23, 22, 21, et cetera, and start setting up a game plan for the changes I need to make to improve my success. So as we think about those resolutions, and we want to get into what's driving the market today, well, first things first, with a new year comes new rotation. We get major sector rotation throughout the timeline of an economic cycle, but particularly at the beginning of a year, there's a lot of rotation. People are moving from previous themes, AI growth, quantum computing ideas, and maybe this year the focus is more on basic materials. Gold and silver have been particularly in the news recently. Or there are times where we go into healthcare, looking at stocks like Johnson & Johnson or United Healthcare. And as that rotation occurs, price changes. As money flow is coming out of Palantir and going into Micron, that's rotation within that tech sector. As money is going out of Palantir or Netflix and into gold, that's rotation between sectors. And all of this has an impact on the direction the market is taking to start the year and setting me up for what I want to focus my energies and my investment or trading portfolio on. I want to trade actively moving, interesting names that are generally getting bought or sold by the market. Those names that are not moving at all generally don't have as much excitement, but those that are moving because people are either buying, there's an increase in demand, or selling, there's an increase in supply, that creates price changes that I can then try to leverage using options or stock or futures. So I think through our rotation, think through our sectors that are in heavy focus right now, and see what the market's doing as a way to help me fine tune the sectors that I want to focus my energies on. On top of that, we've got a lot of political policies that are shifting right now. We look at Venezuela, we look at Greenland, we talk about interest rate focuses, we talk about inflation. All of that comes through the interest rate and inflation, particularly with what the FOMC policy is. And as interest rates go down, that can help spur economic growth. As interest rates go up, maybe it helps stall out some inflationary concerns. We had inflation numbers this morning. These are driving elements of the market. When we have news of Venezuela, it moves oil prices. When we have news regarding inflation, that moves interest rate projections and the broad market. And so knowing what's going to potentially move the market, we got earnings season kicking up right now. JP Morgan and Delta Airlines were this morning, a lot of financial names coming out this week. These are market movers that can then again help me focus on what is showing signs of growth on an individual company or a sector basis, or having an input that could cause future growth and thus speculation on future investment opportunities for the whole broad market community. And again, one of the big things for me is always having that backdrop of what's going on, what are my movers, and how is that going to impact my trading decisions? What has a fundamental input if I'm focusing more on technicals? Because then if I don't have an edge in fundamentals, and there's a lot of fundamental news, I don't want to trade that. But after the fundamental news is out and the technicals take charge again, how am I going to react and where am I going to start to allocate risk into this market? So my resolutions for 2026 is a great example of what maybe could be used for an individual trader. Setting 3 resolutions. I want to look at new trading strategies. So I want to implement one new trading strategy, and I don't have to allocate to that new trading strategy at the same amount of capital that I'm putting into trades I'm comfortable with, strategies that I'm comfortable with, but I can start to look at a new strategy, get an understanding of it, when to use it, and how to make it work for me. Maybe I start off by paper trading this strategy, writing down potential entry and exit points, seeing how things would work, then trading small with it, allocating a small portion of my portfolio, seeing if it's working. Again, keeping those detailed records to know that it's working and that I'm comfortable with it before allocating it to my portfolio. Along with this, setting realistic profit targets. I hear a lot of people feel like they underperformed because they just outperformed the market last year. Outperforming the market is a good barometer for actual having success. It just may not be as much success as one desires. But if I set my target at making 100 times my money on a yearly basis, all I'm going to do is set myself into a mind frame of gambling. Because you can't generate 100 times returns without taking unnecessary risk and gambling with money and knowing that I might lose it all. So if I set realistic profit targets, then I can achieve the success that I'm looking for, and I can set myself into a better tone for the full year. And again, keeping detailed records. This is a key element for traders of any experience level. When I first started trading, I thought, well, these detailed records are great when you're learning and just getting started. But as you get more comfortable, you don't have to keep records anymore. And that's false. I found that by keeping records, I can look back and something I may have forgotten at the time of entry of a trade triggers a response for me. If my initial thought was, I want to be looking to exit this stock if it goes up by 3%. And then it goes up 3% and I don't do anything. And then it goes back to unchanged. That's not a flaw for me in the trade idea. It's a flaw in sticking to my initial strategy and maintaining that, keeping an eye on that strategy and then actually following through with it. So it's a failure in process, not a failure in concept. And that helps me, again, identify whether it was the strategy that was wrong, whether it was the idea that was wrong. And we're all going to have losers out there where, you can't generate 100% guaranteed profits. Otherwise, this market would be the Wild West and you'd have billionaires everywhere. But knowing what caused a failure and what caused a success is crucial. If I have success because of something that was completely outside of my initial plan, that's also important for me to understand because I don't want to attribute my success to something that wasn't really what I saw. Sometimes luck happens. Luck is not a strategy, though. So knowing what caused my failures, what caused my success, helped me set a plan for the future. So we'll start with a new strategy. As we think about options, we always have to remember that options do have risks when compared to a stock. Options generally have higher commissions and fees than stock trades. These are leveraged contracts. They are complex. They do have incremental risk that stocks don't have, such as assignment. If I'm selling a put option with the obligation, if the put holder decides to exercise their option, now I have to buy the stock. If that happens, I now have a stock position, not a short put position. That's a different capital requirement, different risk profile than my previous position. Options decay in value over time. So if I'm buying options and the stock doesn't move, I'm going to be losing money over time because this contract gives me a timeline for when the stock price movement has to occur. The S&P 500 SPY ETF may be trading $800 a share at some point in the future. Is it likely to be trading there in the next 2 weeks? No. The options expiring in 2 weeks for the $800 call are very cheap as a result. But even the $700 call, closer to where we're at right now, that's going to decay in value as we get closer and closer to expiration because at some point it converts into either a stock position or a contract that I have to exit. And then finally, volatility. This is the expectation of future movement that the market is pricing in. It's often referred to as the fear index because the implied volatility tends to go higher when people have a lot of fear about the market. Concerned that we may go into a liquidation event and have a big crash because of a fundamental input that's hitting the market or a technical input that's hitting the market. The VIX tends to get low when the market is confident and stable. So that expected future movement factors into the pricing of the options. And if it's too high for my price target, I have to adjust my strategy. So for most people, the first step on options is thinking about a long call position rather than a long stock position. Now, the P&L graph of a long stock position is very simple. It's very linear. Every time the stock goes up by $1 per share, I increase my balance by $1 per share for every share that I hold. So if I have a $100 stock and I think it can go up 20% in the next month, it's a very volatile stock in this scenario, but it helps to illustrate the potential for what we're looking for here in terms of returns. If my stop loss is if the stock goes down below $90, a 10% drop, and my risk tolerance is $1,000 for this exercise, I can own 100 shares of stock for $100. If that's going to cost me $10,000. But if the stock goes below 90, I stop out of the position and I cap my loss at $1,000. But earnings or some other fundamental input could cause that stock to gap. It happens all the time. Fundamental inputs move stocks beyond my stop or beyond my profit target. I could wake up tomorrow morning and the stock could be trading 85 or 80 or 50, and I lose more than that target loss of only $1,000. And I still have to exit because it's now completely violated all of my technical and my trade idea in the first place. But I may end up losing more than that $1,000 a share, even though I think I'm only risking $1,000 a share. In an extreme case, we could have the stock go bankrupt unexpectedly, and now I lose my initial $10,000 investment. Or I mismanage my trade, and I say I'm going to exit at 90, and it hits 90 and I don't exit, and it goes to 80, then to 70, then to 60, then to 50, and I continue to try to hold this grudge position and continue to lose more money than I initially intend to risk, under a hope that it might achieve my ultimate price target to the upside. And on the upside, if the stock goes to $120 a share, my price target, I'm going to exit and I'm going to make $2,000 as long as I follow my trading plan. And if I don't follow my trading plan, maybe I have unlimited upside. But generally speaking, because I have a trading plan, I should say that while I have unlimited upside, I have a price target that means I really do have a capped upside. So structurally, I have a plan with capped downside and a plan with capped upside, but I do have unlimited upside and greater than $1,000 of risk if I deviate from the plan. Utilizing a call option can give me some benefits of leverage, greater upside, while also ensuring that I stick to my risk tolerance. If the $100 strike price call is expiring in 1 month, and let's come back to that, a $100 strike price call means that I have the right but not the obligation to buy the stock for $100 per share until expiration. Expiration's in 1 month. So over the next month, I can buy the stock for $100 at any given time. If it's trading 90, I'm not exercising my call. I'd rather just buy the stock at market for $90 a share. It's trading 110. I'd certainly like to exercise my call options and take that right to buy it for $100 a share. It's valued at 10% higher than that. That would be a potential for profit. Because I have that defined risk, as well as that leverage and that opportunity to exercise these calls, but not an obligation to do so, these trade at a premium. In this example, let's say that these are trading for $5 per share. Well, then each call option, which represents 100 shares, is going to cost me $500. If I want to risk $1,000, I can buy 2 call options, in theory. That's a $1,000 investment. I've got $9,000 of cash and 2 call options representing 200 shares if the stock goes up. If the stock goes down or unchanged, I'm going to lose my $1,000. I'm not going to exercise my calls, and I'm just going to be out the initial premium paid. If the stock goes up, I start to make profit. If it only goes to $102 per share at expiration, I'm still losing money because I paid $5, and now it's only worth $2. $102 current price minus the $100 exercise price, the strike price. So the value is the difference between the current stock price at expiration and the strike price. If it goes to $110 per share, each call option is now worth $10. And my profit is $10 minus the $5 initially paid, so $5 per share. So in that scenario, I make $1,000. At $120 a share, my call options are worth $20 each. My initial premium paid was $5. My profit is $15. 2 call options, that's $3,000. On a comparison point, at $110 a share, the call options start to perform better. At $90 a share, the call options perform less poorly. Everything in between is where stock performs better than a long options position. Options trading is about the trade-off. Do I want to have that incremental leverage to the upside and that defined risk to the downside because I'm thinking this stock is much more volatile than the market? If I think this is a stock that's likely to go up 1 or 2% over the next month, I don't need to buy call options. I'd be better off in stock or finding a different way to hedge my risk. If I think this has a chance of being up 20, 30 or more percent, the call options provide me a leveraged way to do so. And if I think there's a chance I wake up tomorrow morning and this stock is trading 50, but more likely it's going to 120, certainly I'm looking at call options because I want to have that defined risk to the downside and I want to have that leverage to the upside. And so, on the net of this, the goal with options is to allow myself that leverage to the upside and define my risk to the downside so I can sleep better at night. The leverage is the goal. That is the target. The defined risk allows me to ensure that I have more capital to allocate to other trades while also sleeping better at night. So if I'm using options, one of the thought processes for me is how can I leverage them more than just a call option? If I'm predicting not just the direction of the price movement, but also where the stock will find new resistance and could stall out, I can pinpoint my trade. I can set a price target that will also allow me to use a complex option strategy that will allow me a greater return. Now, in options, I always want my stock price to go through my long call strike and stop at my short strike, or go through my short strike if I'm not hedging. The goal of a debit spread is generally, though, to hit my price target and stop there. That's why resistance on a technical basis is often a key input. I look for a price that the stock is likely to get to if investors are still involved, but where they may no longer be buying or where we may see some supply. Resistance is generally where we've seen supply in the past, where people have been selling before. When you're at all-time highs, it's harder to pinpoint that, but we'll talk about ways to do so a little later on. Now, a debit call spread takes a simultaneous long position in one strike call and a short position in a higher strike call with the same expiration date. An example would be if I were to buy the $100 call and sell the $106 call. I am now initiating a position with the goal of price appreciation and capping my return once we reach $106 per share. That's my profit target. That's my price target. If we go to $120 a share, $160 a share, or $3,000 a share, I'm capped out and out of my position at 106 or higher at expiration. A call has that unlimited upside if I were to hold on to it. So when I have a more conservative goal, a 6% rally in the stock, a call spread, a debit spread, may be a better avenue for me. It's a trade-off again. Anywhere between $100 per share and 112 and change, about $113 a share, my call spread position is better. If I am incredibly bullish and expecting a price rally to $120 a share, I'm certainly better in the call. But if I think there's a high probability of settling in somewhere between $105 and $107, I have a much better return by buying a call vertical and enjoying the full appreciation of this call spread, which caps out at the difference in the spreads. So in a $100 call, $106 call vertical, the max value is $6, the difference in the strikes. If my initial price was $2.30, I can buy roughly 4 call verticals for the same price, same amount of cash as buying 2 outright calls. And that's why I get actually more leverage for something that is technically less leveraged to the further upside. It's more leveraged for a small move, less leveraged for a big move. But if part of my goal is to bring back in my profit targets and reset my expectations of a stock movement, this is a great way for me to do so. It allows me to continue to buy options for leverage without needing a 15, a 20% run to start generating better returns than a stock trade. On the other side, I can set it even more in the favor of probability of success and lower leverage by selling a put credit spread. If I think a stock may not go up, but at the very least, I'm very confident it won't go down, I can sell a put credit spread. And in that scenario, I simply need the stock to stay above my short strike. A credit put spread takes a simultaneous short position in one strike put and a long position in a lower strike put with the same expiration date. So my example here would be if I were to sell the $95 put, as long as we stay above $95 a share, I get to collect premium and keep it. And if we go below $89 a share, that's my long strike, I'm stopped out of my position. So this gives me a scenario where instead of looking for big upside movement, all I need is for the stock to stay above, in this scenario, $93.45. The high strike minus the initial entry, the initial credit. So I collect $1.55 per call put spread sold. My max loss is $4.45. The difference in the strikes minus the initial credit. And I have this high probability of success, but with a lower general return. Again, the call position has that big upside with a max loss at $5 per contract. The put credit spread has a similar max loss per contract, a little bit less here, again, $4.45, a max upside, but a window where I'm making money anywhere between 95 or 90, sorry, 93 and a half roughly and above. With the call position, I need to get above 105. So I don't have to be nearly as optimistic and have nearly as big of an expectation on the move here. I can simply collect some credit and then wait. And as that option decays, I slowly collect that premium. Ultimately, if we're trading, say, $100 a share at expiration, my put credit spread achieves max profit. My call position achieves max loss. Again, ways for me to find bigger potential returns with a lower return, but a higher probability of success. I've got a big window where my put credit spread performs better than a call. And again, if I think this stock is going to 115 and I'm really confident, I don't need to sell a put credit spread. I would look at a long call or a long call vertical with something more optimistic than this. But this gives me a lot more potential for repeated compounding returns, which ultimately is a big goal for a lot of traders. Increasing the odds of success, having more winners than losers. This is where I find that. The comparative risk reward for these three is, frankly, that a long call is going to have the highest potential return, but the lowest odds of success. In the middle would be my long call vertical. I have a bigger return than a put credit spread and a lower return than an outside call, or an outright call. I have better odds of success than an outright call. And my put credit spread gives me the highest odds of success, but the lowest return. In an efficient market, all of these net out to the same expected value. When there's a market inefficiency, which is where I find my edge, I have to structure the trade based upon where my edge is. If my edge is on the rate upside of the stock, my option structure is the call. If my edge is on limited upside, my edge may be in the call vertical. If my edge, my efficiency, my analysis says that there's an unlikely scenario where the stock falls below support, my edge means that I should be looking at a put credit spread. And then choosing the right structure is the way that I help improve my returns for the long haul. Generally speaking, spreads do give that higher probability of success and often give people a lot more confidence in their trading. And so it can be a great strategy to use for those looking for a way to improve their percentage of winners. So when I'm looking for a strategy, let's talk about the call vertical in particular. Oftentimes, I need to set those realistic profit targets, my second New Year's resolution in trading. I don't feel like oftentimes, or I may not feel like oftentimes, I hit my profit target. Every time I trade, I find that I set a profit target of a 20% return and the market comes up short and I only get 10%. Well, maybe then the problem isn't in my direction, but it's in the magnitude of the move. And so I need to think about some statistical elements to try to set a more realistic profit target. Train my own brain to stop being so optimistic and find ways to increase my returns in the process. And this is where I can use an input from the market, implied volatility, to help me set more realistic profit targets. I can look at the market and say implied volatility is the expected future movement. It's annualized. The VIX is giving me the annualized expected movement for the S&P 500. If it's at 15%, it means that the market is basically pricing in that from here, the S&P 500, 1 year from now, should be trading 15% higher or 15% lower on average. It's kind of a simplification of it, but it gives you a general idea of what we're looking for. The VIX goes up when the market goes down. That recovery potential means that there's greater upside. That liquidation potential means there's greater downside. And now the market is moving more. Realized volatility is what we've seen recently. Implied volatility is what the market's expecting in the future. And keep in mind, because realized volatility doesn't guarantee future volatility, but oftentimes they do have a correlation. Times when they don't, earnings announcements. A stock moves on earnings and then settles in at a new price given the the current inputs. When we're getting volatility outside of an earnings announcement, oftentimes the market does continue to move. When it's based upon a fundamental input that is now known, we're going through the digestion phase. So implied volatility falls because the stock is now repriced based upon the data that we have, and the investment community is more confident at the new valuation for that company. When I'm looking at that implied volatility, I go back to my old statistics class and say, okay, well, what's the odds that we're going to move more than the market is saying? And on average, we're going to stay within one standard deviation. So within that band. If the VIX is 15, plus or minus 15% is likely to occur 68% of the time in an efficient market, assuming a normal distribution. It's a little bit different than this, but this is a good simplification for us to get a general idea. Moving up more than one standard deviation should occur about 16% of the time. Moving down more than one standard deviation should occur about 16% of the time. So if I'm looking to set a price target, if I'm bullish and pricing in a move of one standard deviation or more, I really am only going to hit my profit target about 16% of the time. It's not a huge return, but it does give me, or a huge odds of success, but it does give me, I think, some understanding of just how bullish I am being when I set these price targets. If my goal is to achieve one full standard deviation of movement, I'm probably only going to have that happen 1 out of 6 times. Where we get a problem is that a lot of traders start setting profit targets of 2 standard deviations or more. And these are outlier occurrences that happen very infrequently. And so we start to tell ourselves that we're not very good at this because we now have a profit target and we never seem to hit it. Well, if it's happening 1 out of every 50 trades and you make 1 trade per week, if you have 2 trades hit your profit target for the year, you've actually outperformed the statistics. But you haven't felt very good about it. So we try to rein that in. I try to rein that in and look for ways to get a more realistic profit target. And I'm just going to step back to 1 standard deviation for simplicity here. And so with 1 standard deviation, again, something that should really only happen about 1 out of every 6 trades, I have to know how to calculate that. 1 standard deviation over my time horizon, just a good starting point for when I may want to book some profits, because that's going to give me 1 out of 6 trades are going to hit that. And I want to structure trades that are going to hit profits before we get to a full standard deviation move. But this would be a spot where I may want to exit early. Now, if I use that implied volatility as an estimate of the annual percentage move, I need to pare this back to a shorter time period. If I use 1 month as my normal time horizon, I don't take the implied volatility and divide it by 12 to get it to monthly terms. I divide it by the square root of 12, about 29% of the implied volatility. In a 15 VIX world, that's about 4.5%. Still very optimistic, but if I'm looking at it in terms of what this really means, I'm saying that when I'm bullish, I need the S&P 500 to go up 4.5% over the course of a month. That's a very bullish bias. In general, if you had that every month, of course, we'd be looking at greater than 50% returns for the year, not likely to occur. But I think that just generally gives some perspective on why these numbers are there and how to help rein in some of these bullish expectations or bearish expectations that many people have. So as I mentioned, the VIX is around 15% right now, and I just wanted to illustrate here when we had some market panic, it can get up to 30%. This is based upon monthly expectations. So the VIX is off of a 30-day implied volatility, not an annualized. The annualized volatility does move a little bit less, but the general range here is between around 14-ish% and we'll call it 18%. So right around that 16% number, with spikes when the market is panicking and troughs when the market is stable. Or we're going into the holidays like we saw recently. We got down to around 13%. And when we've got the S&P 500 trading at $690 a share, I can then start to set my expectations. If I think the next month is going to be particularly bullish, one of those 1 in 6 scenarios, one of the 2 most bullish months of the year, I can set my price target as 4.5%. Well, 4.5% is around $30 a share. That'd be $720 per share a month from now. So if I'm bullish, maybe I go a little bit less optimistic. I pare it back a little and say, I think that this market can get to $715 a share. The market's saying that the actual probability of that occurring is only about 1 in 10 times, 10%. That's based on the options market. If I start buying $696 calls for $10, this was a couple of days ago. They're actually up a little bit now since we've had a market rally. If I hit my price target at $715 a share, I get an 89% return. That's pretty solid for a month. That would make me feel pretty good. But again, it's only going to happen about 1 in 10 times. And if I exit at 715 no matter what, I don't have any possibility of that bigger leveraged return. So if my game plan is to exit at 715, nothing to the right of 715 matters. If I stick to my game plan, none of this is a possibility. Everything below is a possibility. And if we don't get to 706 by expiration, I'm not making anything. On the other hand, I can look at a call vertical. And in a more bullish scenario, I can buy a 710, 715 call vertical for $1.31. And if I hit my price target, I have a 280% return. So I now have a bigger return with the same probability. So still a 10% chance of making money, but a much larger return. And everything to the right of 715 doesn't matter to me again because I'm exiting at 715. So all of this being the same return is fine by me because I've set a realistic profit target that I'm going to exit either way. This gives me a greater return without reducing my odds of success. The only thing to consider here is that I do need to get above about $711 a share before I start making money. So I do have to have a more bullish scenario in this case in order to start making money. But I have that great return if we start to see a really bullish market. And I've still generated a great return, but even more so than a long call position. And then finally, a big thing for me is trading journals. This is one for shares. I can go through and write down the date of my entry point, what the stock symbol is, company name, my initial buy price, whether it's stock or options. I want to have my initial entry. I want to have my stop level, my target price, how much money I'm risking, my position size, the total position value, and then here's the big one for me, the comments. And writing in here what I'm planning on doing at the beginning of a trade so that I can go back to it and say, the S&P 500 SPY has hit $715 a share. My initial plan was to exit at 715. If I'm going to deviate, I need another entry here explaining why. Because if I don't, I'm not sticking to my process. I'm not sticking to my strategy. And it gives me accountability within my trading to make sure I'm sticking to the strategy and setting my price targets right and achieving the returns that I planned to return when I've got to win. And when I exit early or exit late, I need to tell myself why so I can go back and evaluate it. At the end of the day, trading is a business. If I deviate from my strategy and I don't hold myself accountable, maybe nobody else will. If I'm only trading my own money, I don't have anybody else to be accountable to except for myself. And I need to make sure that I understood what went wrong and why. And then the exit side of things, the actual transaction can give me a window of how I actually went through this process, what the profit and loss was, the loss. And frankly, I like to add another comment and go through afterwards and evaluate the trade and explain to myself what went right, what went wrong, why did I make money, why did I lose money? Was it because I had the right idea and it paid off, or was it because I got a little bit lucky? And be honest with yourself with your trade journal, because if you're not honest with yourself, then it means nothing. If you fill out a trade journal, you stay honest to yourself and you explain to yourself why you made money, why you lost money. It's not the market's fault, or it is somebody else's fault. Sometimes it happens, but usually the only person that is accountable and responsible for the profits and losses is the person executing the trades. And review it. And a year from now, when you're going through your trading from 2026, if you're seeing things that weren't working, you'll now know why. You'll see those trends. You'll see the reasons that things worked, the reasons things didn't, and it'll help set a game plan of how I need to adjust my plan for next year so that I can improve my returns and set better resolutions for 2027. And as we go through this process, the learning process, the accountability process, and the implementation of strategy process, long term, the success I expect will traditionally improve. Not always, but more people that keep journals than not, I think, have generally shown to have greater success because that allows you to have that reflection time. If you have questions, feel free to throw those in the chat box or the Q&A now. Or if you have questions after, you can always email me. I'm Keith@optionhotline.com. Again, there's my phone number. And as I mentioned at the beginning, keep an eye out for support at optionhotline.com to receive some free giveaways from Option Hotline and myself. Hopefully they can help you with some of your trading ideas. And if you have questions outside of what we talked about today, I'm always happy to help.
Thank you so much, Keith. I'm going to ask you to put that slide back up that has the sample trading journal, because I think really you're hitting on a fantastic point here about, going into a new year, setting yourself up for success, the comments, right? The being brutally honest with yourself at the beginning, during the middle, and at the closing of any actual trades. It's got to be the best information to really gift to yourself. Have you noticed, I don't know if you still use handwritten trading journals like this, or have you noticed if there's been, an uptick in apps or technology that people can do this stuff online? I would imagine there's probably a myriad of different ways for people to track their trading.
Yeah, absolutely. I mean, I think that there's a lot of ways to do this. And, I'm a little bit old school on it. I tended to write it out by hand. The thing that I made a mistake with was I had a period where I stopped keeping a journal. And when I went through drawdowns, I found that I had a hard time understanding why. So I would have a period of lack of success and say, okay, well, it just must be market conditions. But if I had kept the journal, I could go back and say, oh my gosh, there are ways for me to keep an eye on this and understand what actually was happening, whether it was an increase in market volatility, fundamental inputs, or if there was something fundamentally flawed in what I was doing. But yeah, you hit on it. There are really good ways to do this online, and that helps store the information because when I've done handwritten notes, I can lose them. And I don't want to do that. So keeping that record digitally is a much easier way to make sure that you don't lose those records.
Yeah, for sure. Understood. I mean, I think you make a good point. It's really dependent upon the person, right? The individual, what works best for them. But it's great too that you're pointing this out, and it's really just information, individual investors can gift themselves, even if they don't realize they're doing it in the moment. So awesome to put that up there. Thank you. You can put your contact info up one more time, just as we wrap up here. A reminder for everyone to write down Keith's contact info if you want to reach out regarding any follow-up questions on this presentation. We're pushing right up against our time frame here, and inevitably you all might have questions in an hour or 2 days from now or next week. So write this information down, and I'm going to take back screen in the meantime and just start to wrap everything up here. I want to thank you, Keith, so much for taking the time to talk with us this afternoon and really walk us through some solid, actionable steps to put a new year trading plan into effect. And thank you for everyone who took time out of their days to join us live. And for those of you watching on replay, scoop up all this great information and join us back at the next free educational webinar coming up this week, and we'll have you back in the future, Keith. Thank you all again so much, and good trading to everyone. I hope you all have a wonderful start to 2026.
Thanks again.